AI is destroying SaaS stocks. Salesforce, ServiceNow, and Adobe are getting absolutely crushed. But what if Wall Street has it completely backwards? Right now, the biggest software companies on the planet are in free fall. Investors are panicking. Billions of dollars are vanishing from the sector every single week, and the reason is simple. Everyone thinks AI is about to make these companies irrelevant. But here's the thing. Most of the people selling have never read a single one of these companies' financial statements. The SaaS Bloodbath. Let's start with Salesforce. This is the biggest pure play cloud software company in the world, $148 billion market cap. And over the past year, the stock is down 27%. Year to date, down 30%. The company that literally invented cloud CRM is getting treated like it's going out of business. ServiceNow, even worse. This was one of the hottest enterprise software stocks on the planet. It hit over $211 per share last year. Today, it's sitting at $90. That's a 44% drop in 12 months. 44% for a company growing revenue over 20% a year. Adobe, the company that owns Photoshop, Premiere, the entire Creative Cloud, down 31% over the past year. Workday, the gold standard in enterprise HR software, down 46%. Even Snowflake, a data cloud darling, has lost over a third of its value this year alone. Add it all up, and the IGV software ETF, which tracks these stocks, is down 19% just this year. Hundreds of billions in market cap wiped out. But here's the twist most people miss. The thing that's killing these stocks might actually be the thing that saves them. 5 reasons it's happening. Reason number 1, AI replacement fear. The narrative goes like this. Why would any company pay Salesforce $200 a seat when ChatGPT or Claude can write code, draft emails, and automate workflows for a fraction of the cost? It sounds terrifying if you own these stocks. Reason number 2, margin pressure. AI isn't free. These companies are spending billions to build their own AI features. Salesforce built Einstein AI and Agentforce. ServiceNow built Now Assist. Adobe built Firefly. All of that costs real money. And investors are worried it'll crush margins before it drives revenue. Reason 3, slowing growth. A few years ago, these companies were growing 30, 40, even 50% a year. Today, Salesforce is growing in the low single digits. Snowflake has slowed to the 20s. When you're paying a premium for growth and the growth disappears, the stock gets punished. Reason 4, multiple compression. This is the big one. Salesforce used to trade at over 40 times earnings. Today, it's down to a forward PE of about 12. Adobe, 9 times forward earnings. Workday, under 10. The market is pricing these companies like they're value stocks, not growth stocks. And reason 5, the great rotation. Money is flooding out of software and into AI infrastructure. NVIDIA has been on an absolute tear. Investors want the picks and shovels, not the software that sits on top. It's like everyone ran to buy the drill and forgot they still need the house. To put it in perspective, Salesforce is down 27% over the past year. Meanwhile, the company that everyone is rotating into, NVIDIA, kept climbing. The gap is enormous. Still with me? Because this is where it gets interesting. Why the fear is wrong. First, the companies everyone says AI will destroy are actually the ones building AI. Salesforce didn't sit on its hands. They built Einstein AI, which is embedded across their entire platform. And they launched Agentforce, which lets companies deploy autonomous AI agents at scale. These aren't side projects. This is core product. ServiceNow built Now Assist, an AI layer baked right into their workflow platform. It helps IT teams resolve tickets faster, helps HR teams answer employee questions automatically. And because ServiceNow already sits at the center of enterprise operations, they have massive distribution built in. Microsoft built Copilot and embedded it into Office, Teams, and Azure. They're not replacing SaaS. They're adding AI on top of SaaS. That's the pattern. The best software companies are using AI as a weapon, not dying from it. Second big point, switching costs. People wildly underestimate how sticky enterprise software is. Switching from Salesforce is like changing the engine of a moving car. These systems are woven into every department, every workflow, every database. It takes years and millions of dollars to rip one out. That's a moat ChatGPT can't just walk across. Third, these companies aren't dying. They're evolving. Every major SaaS player is embedding AI into their existing products and charging more for it. That's not disruption. That's upselling. The very thing Wall Street fears is actually becoming a revenue accelerator. Here's the one thing that changes everything. The opportunity. Look at the valuations. Adobe is trading at 9 times forward earnings, Salesforce at 12, Workday under 10. These are companies with recurring revenue, massive customer bases, and gross margins above 70%. You're getting best-in-class software franchises at prices we haven't seen in nearly a decade. And the demand for enterprise software isn't going away. If anything, AI makes software more important, not less. Companies need platforms to manage their AI agents, store their data, and automate their operations. That's exactly what Salesforce, ServiceNow, and Snowflake do. Warren Buffett said it best: be fearful when others are greedy, and be greedy when others are fearful. Right now, the fear in SaaS stocks is extreme. Sentiment is the worst it's been since 2022. And historically, that's exactly when the best long-term returns start. The global enterprise software market is projected to hit $1.2 trillion by 2030. That's not a shrinking pie. It's one of the biggest growth markets in the world. But what about the risks? Look, I'm not going to sugarcoat it. Not every SaaS company will survive this transition. Some smaller players without real AI capabilities could get eaten alive. Even the big names face real risks. If AI coding tools get good enough, some development platforms could see real displacement. And if the economy slows further, enterprise IT budgets get slashed first. And these stocks could absolutely stay cheap for a while. Sentiment can stay negative longer than you think. Just because something is cheap doesn't mean it goes up tomorrow. You need patience with this kind of setup. And the stomach to hold through more volatility. Quick recap. SaaS stocks are getting crushed. Salesforce down 30%. ServiceNow down 44%. Adobe down 31%. The fear is that AI will replace them. But the reality is these companies are building AI into their products. They have massive switching costs, and they're trading at valuations we haven't seen in years. Smart money pays attention when everyone else is running scared. That doesn't mean you go all in blindly, but it does mean you start doing your homework, because the biggest opportunities usually show up when they look the ugliest. If you found this helpful, hit subscribe. We break down stuff like this every week. And remember, this is not financial advice. It's for educational purposes only. Always do your own research, and thanks for watching. I'll see you in the next one.